In the late 1980s, the United States government assumed responsibility for hundreds of failed financial institutions whose names were largely unfamiliar outside their regions. The cost was eventually estimated at more than $100 billion, spread across taxpayers, deposit insurance funds, and the balance sheets of surviving banks. At the time of the largest closures, there was no single panic, no day when markets seized across the country. Instead, examiners arrived quietly, doors were closed over weekends, and deposits were transferred with minimal disruption. What required years to unwind had taken decades to assemble. The system did not collapse so much as it exhausted its margin for error. Savings and loan associations had once occupied a narrow and clearly defined role. For much of the 20th century, they existed to accept local deposits and convert them into long-term fixed-rate mortgages. The arrangement was stable because it was simple. Deposits paid modest interest, mortgages earned slightly more, and regulation constrained both sides of the balance sheet. Interest rates moved slowly, competition was limited, and failures were rare enough to be managed without attention. This stability was not accidental. It reflected assumptions formed during a period when inflation was low, capital controls were common, and financial innovation advanced cautiously. Regulators enforced interest rate ceilings, geographic restrictions, and conservative asset requirements. The institutions themselves were often mutuals, owned by their depositors rather than shareholders. Profit maximization was not the organizing principle. Continuity was. By the late 1960s and early 1970s, these conditions no longer held. Inflation began to accelerate, driven by fiscal pressures, commodity shocks, and changes in monetary policy. Market interest rates rose faster than regulators had anticipated, and faster than the balance sheets of savings and loans could adjust. Their assets were long-term mortgages locked in at fixed rates. Their liabilities, deposits, were increasingly mobile and sensitive to yields elsewhere. As inflation persisted, a structural problem became visible. Depositors could earn higher returns in money market funds and treasury securities than savings and loans were permitted to offer. Funds flowed out. Institutions responded by paying more where possible, narrowing or eliminating their interest margins. On paper, many remained solvent. In practice, their business model no longer functioned. Regulatory responses were incremental and constrained by competing priorities. Policymakers were reluctant to allow widespread failures in a sector associated with home ownership and local credit. Deposit insurance coverage was expanded, reducing the incentive for depositors to discriminate among institutions. Interest rate ceilings were gradually lifted, allowing savings and loans to compete for funds. Asset restrictions were relaxed, permitting investments beyond traditional mortgages. These changes were not conceived as a transformation. They were framed as adjustments meant to preserve the existing system. But taken together, they altered incentives in ways that were not fully reconciled. Institutions that had been designed to be conservative were now able to take on higher-risk assets, funded by insured deposits, while still operating with thin capital buffers. By the early 1980s, the environment became more volatile. Interest rates rose sharply as monetary policy tightened to contain inflation. Many savings and loans were technically insolvent, though this was not always recognized or enforced. Accounting rules allowed institutions to defer losses and count speculative future income toward present capital. Supervisory agencies, constrained by limited resources and political pressure, focused on managing decline rather than enforcing closure. For management teams facing insolvency, the range of choices narrowed. Conservative strategies offered little chance of recovery. Riskier investments, by contrast, provided a possibility, however remote, of restoring solvency. The structure of deposit insurance ensured that the downside of failure would not be borne by depositors, while the upside of successful risk-taking would accrue to owners and executives. This asymmetry shaped behavior. Some institutions pursued aggressive growth, attracting deposits with high interest rates and deploying funds into commercial real estate, land development, energy projects, and complex securities. Geographic expansion accelerated. Local lending gave way to national exposure. In certain regions, particularly the Southwest, real estate values rose rapidly, reinforcing the perception that risk was manageable. Regulators observed these developments through an institutional lens shaped by earlier decades. Examination processes were slow. Enforcement actions were negotiated. Closure was considered a last resort, in part because the insurance fund itself lacked the capacity to absorb mass failures. Each decision to forbear, allowing an institution to continue operating despite insolvency, was defensible in isolation. Collectively, these decisions accumulated risk. The situation did not deteriorate uniformly. Some savings and loans adapted prudently, recapitalized, or converted their charters. Others failed early, their losses contained. But a subset expanded rapidly under conditions that masked underlying weakness. Growth became a signal of confidence rather than a symptom of distress. By the mid-1980s, the scale of the problem exceeded the capacity of existing institutions to manage it quietly. Regional downturns exposed concentrated real estate portfolios. Energy price declines undermined loans tied to oil-producing areas. Projects that had depended on continued price appreciation stalled. Losses that had been deferred became unavoidable. Policy responses accelerated. Congress authorized new resolution mechanisms and recapitalized insurance funds. The Resolution Trust Corporation was established to manage and dispose of failed institutions and their assets. The process was administrative rather than theatrical. Failed savings and loans were seized, their assets auctioned, their liabilities transferred. Entire portfolios of real estate and loans moved through secondary markets at discounts that reflected years of accumulated mispricing. The closures themselves did not resemble a crisis in the conventional sense. Depositors retained access to funds. Mortgage markets continued to function. There were no widespread runs. The disruption was fiscal and institutional rather than immediate and visible. Costs were recognized gradually through appropriations, insurance assessments, and absorbed losses. As the resolution unfolded, narratives began to coalesce. Some emphasized individual misconduct, pointing to cases of fraud and self-dealing that emerged during investigations. Others focused on regulatory failure, highlighting underfunded agencies and delayed enforcement. Still others framed the episode as an inevitable consequence of deregulation. Each of these accounts captured elements of the outcome without fully explaining its persistence. Fraud was present but not universal. Regulators made errors, but often within constraints imposed by statute and funding. Deregulation altered incentives, but it did so in response to genuine structural pressures that the earlier framework could not accommodate. What the crisis exposed more clearly was a mismatch between institutional design and economic reality. Savings and loans had been structured for a world of stable prices and predictable interest rates. When that world disappeared, adjustments were made piecemeal. Constraints were lifted without corresponding changes in capital standards, supervision, or resolution authority. Deposit insurance, intended as a stabilizing feature, became a conduit for risk when combined with expanded asset powers. The timing of recognition mattered as much as the origin of losses. Forbearance delayed closures in the hope that conditions would improve. In some cases, they did not. The resulting expansion of insolvent institutions increased the eventual cost of resolution. This dynamic was not driven by a single decision, but by repeated judgments that favored continuity over confrontation. In retrospect, the crisis did not hinge on a single policy error or market shock. It unfolded through the interaction of long-term economic change and institutional inertia. The regulatory framework responded to symptoms rather than structure, allowing risk to migrate rather than dissipate. By the time intervention became unavoidable, the scale of exposure had grown beyond what incremental measures could contain. The aftermath reshaped financial regulation. Capital requirements were revised. Supervisory authority was consolidated. Accounting standards were tightened. Many savings and loans disappeared entirely, absorbed into commercial banks or liquidated. The specialized model that had defined the sector for decades did not return. Yet the resolution left certain questions unresolved. Deposit insurance remained a central feature of the system, its benefits and distortions still intertwined. Forbearance remained a tool available in future crises, its use dependent on judgment rather than formula. The balance between innovation and oversight continued to evolve, informed but not settled by past experience. As the assets of failed institutions were sold and the agencies dissolved, the episode receded from public attention. What remained were altered rules, absorbed losses, and a quieter understanding of how stability had been assumed rather than ensured. The system adjusted, as it often does. What lingered was not a verdict on regulation or markets, but a recognition that alignment between incentives and oversight is provisional, and that its failure is often visible only after it has already been accommodated.